Hi, Matt McAleer. December 28th, just after the close, end of a brutal month in the equity markets, solid month in the bond markets. Why don't we touch on that just for 10 quick seconds. Had the 10-year rally throughout the week. Munis rallied. December's been a very good month for bonds. That's very helpful in our fixed income accounts and our balanced accounts, which are split between equities and bonds. But let's talk about equities. That's where the volatility is. That's what we've been dealing with for about 8 weeks now. Spoke last Friday with David about some things we were seeing in the markets. We're starting to see panic. I talked about an equity put-call ratio that hit 0.91 and 0.97 last week, 2 different days. High, but not extreme. That changed on Christmas Eve. We hit a 113. That's a number that is very indicative of panic. Too many people pushing to one side of the boat. That's put buyers over put callers. We saw the reaction to that today after Christmas with that big rally. So now where are we? We are working off lower lows. Broke all of our support through last spring in the equity markets. Let's call it the S&P for simplicity's sake. Normally, when we've broken those lows and are in a downtrend, V rallies are the exception, not the rule. We've gotten used to V rallies over the last, let's call it 6 years, since 2011, 7 years. We probably have some more work to do over the next 30, 60, 90 days. We need to see if those Christmas Eve lows hold. We got extreme negative readings in both sentiment and on momentum. We're looking at some weekly momentum numbers that we haven't seen since the winter, just call it December, January of 15, which a lot of people forget the Russell was down 20% in that stretch. And back to 2011, which was June to November. It was ugly. That was the Russian ruble crisis, and we've been through them all. I don't like to bring 2008 into the game because I don't think we're on the same kind of financial breakdown structure as we were then. So let's try to contain it to what we're looking at day to day. While the economy may slow, and that's yet to be seen, especially with some, a little bit of talk that perhaps rates may be capped somewhere here in the near future. With an economy that's decent, I don't see the kind of downside we saw in 08. Don't forget, November 07 to March 09, 58% loss in the S&P. This is a skirmish. This is a Civil War skirmish, not a battle right now, that we'll overcome with some intelligent trading. Where are we in our accounts? US ETF, fully invested, suffering in a couple of areas there. Predominantly energy, as I've mentioned in the past. We have not rebalanced that and bought more. There will be a spot where we do enter energy, especially as we've approached these 2015 lows in the energy ETFs. Tactical trend, which is a little more flexible of a strategy. Remain cash heavy, between 40-45%. We'll mention that we nibbled on biotech today in tactical. We got a small buy signal off of a bottom, and we just took a small position there, 3%. In international, still fairly defensive, 35% cash. We're looking daily at our regions, at our countries. What are we looking for? We're looking for a higher low. That is golden in a downtrend, in a tough market. Something we can work off of, something that we can buy with some confidence. More importantly, something we can work against on a risk level. To buy into a straight downtrend is too much guesswork for me. But like to let this market pull down hard, try to rally as it's doing now, and see what we can do. We have plenty of time. We have weeks, months, quarters to make money. Let's keep that powder dry, keep looking for good entries, and we'll find them. Have a great weekend and a great new year. We'll talk next Friday.